I'll specifically say also for those of you who are new to this channel, a lot of the data that I'm going through, I actually hit and put shorts and videos out as they're happening. And so this is not just a recap of what's happened throughout the week, but we also hit some major highlights and bigger topics that I can't cover in a 30-second short or a 3-minute video through the week. But if you want it hot right off the press, obviously like and subscribe here on our YouTube channel. But you can also follow me on TikTok, Instagram, Twitter, and my LinkedIn profile. My two most active are probably my TikTok channel and my Instagram channel as well. But let's go ahead and get started. I'm going to start with some of the really hot stuff. I recently got asked to be part of a group that's here in the Utah Valley that consists of some of the wealthiest guys in the Valley, specifically tech sector. I would say, I'm trying to think if any of them aren't in tech. A lot of them venture capital, a lot of them tech. And they've asked me to participate because of my AI involvement, my knowledge around AI, and some of the development stuff that we're doing in our company around AI. And as a trader, I'm also interested in AI, as you guys may be. It's like, where do I invest? How do I get into good investments? And I was listening to, I'm a huge fan of this podcast called the All On Podcast. And this is definitely a plug for these guys, even though I'm not getting paid to do this. Maybe they'll give me a free ticket to their summit or something for doing this. But about a week ago, they did a post, and I took the video, shortened it down so you guys could watch it with me here today, on some of just the idiotic investments that are going into AI right now. And if you're looking into AI, or maybe you've already made some investments and it's time to like go through and sharpen the pencil to see if this is a good thing to hold. Right now, it's kind of a foolish man's game. Like anyone can get in. It's like the growth stocks are growing, even if they don't make sense. They don't actually have a product. And we're seeing kind of this boom, this just, fire blazing, so to speak, in the AI market, where a lot of the tide is going to come back out and we're going to see whose pants are down. And if you're in an investment that doesn't make a lot of sense, obviously that's going to be something you want to get rid of. Now, obviously, this is not financial advice. I'm pulling data from these guys' podcasts. Obviously, I'm making my own financial decisions based on some of this data, but you've got to hear this video from these guys. Chamath goes on a dialogue, a full dialogue on AI investing and where all the money's actually going. If you have a sensitive ear, this may not be for you. He does like to use some vulgar language, but if you're an adult, you can handle it. Get the details from this. But let's hear from these guys on the All On Podcast regarding AI startups, this kind of over hot market, and what you can be looking for as an investor on whether you should be putting money into a certain startup project or even a publicly traded company at this point. So here is from these guys.
Speaking of AI funding, there was a breaking news story just in the last 48 hours. A startup named Mistral AI has raised a $105 million seed round, they're calling it. Should be at about a $240 million valuation, according to reports. One of the co-founders is a DeepMind researcher. I guess people were saying this is insane because they haven't written any code yet and they've been working on the company for a couple of weeks.
Part of why these rounds are so big is, I guess, that you have to buy all these H100s and they're expensive and these rigs are very expensive. I mean, you guys saw this, that Nat Friedman basically published that he spent $75 million on a bunch of hardware. And if you were one of his portfolio companies, you could use it. So getting these H100s and A100s to train on seems to be a non-trivial task. And they're very expensive, even if you can get a hold of them. So I think what we're talking about is basically that these rounds have to go up. Because if you notice, like the post, you had to raise the post so that it wasn't so utterly dilutive as to completely disincentivize the employees. But let's be honest here. Nobody's writing a $105 million seed check. That $105 million is chopped up probably 10 ways to Sunday. So there's a bunch of people putting in 5s and 10s and 15s.
I
And I'll
asked
just
one
be
of the
honest with
people
you.
in the round and they said it was massively oversubscribed.
Yeah, so it's everybody taking a little teaser bet. The problem with these teaser bets is they never hit in the way that you think. Maybe you'll get your money back with all the dilution that's going to happen, et cetera, et cetera. This is not the way to make money, guys. I'm just going to be honest with you. So whoever's putting money in thinking they know what the fuck they're doing, you might as well just light it on fire, go to Vegas and have some fun with it, because you will make more, you'll get more enjoyment from that than you will from making these kinds of investments.
What do you think, Brad?
It's dumb. Stupid.
Stupid bet? Brilliant bet?
Well,
reasonable
by
bet?
the way, this has nothing to do with the company, nothing to do with the
company.
idea.
I
I'm
guess.
saying,
Just talking about bets.
when you're betting $4 million in a $105 million round at 240 posts, you do not know what the fuck you're doing. That is not the job.
So again, Mr. There are going to be a couple monster rounds, I think, announced next week, like that are going to make this one look like kids play. So a lot more of this is coming. You're exactly right. This is about buying H100s and compute. Everything we're talking about, right? An essential ingredient is compute, and it's a scarce resource.
My God, these people that put the money in the seed round should have just bought NVIDIA. Buy some call options so you get more money.
Well, and there's downside
And
protection
it's
because
insane.
NVIDIA has a floor.
And by the way, because just in case Mistral doesn't work, NVIDIA will sell those H100s to somebody else.
The resale value. Yeah, they probably have the option to resell them.
Crazy.
I do think you're
Crazy.
right on these teaser bets. This is a power law business. There's a massive pressure on young junior partners, principals within these firms to do something.
Fire
So
them.
it's not just teaser bets. What happens in these
Fire them.
places
Fire
is
them.
they want
Fire
to
them.
get the logos because they need to explain to
Logo
the
and
LP.
sorry.
No, actually,
they're
no, that's
doing
even
something.
worse. The GP that can't manage their fucking principal should be fired.
Right. And so
Those people should, the young people should shut the fuck up. Okay. Be lucky you have a job. Learn the craft. It'll take you a decade. And if you are proposing stupid bets like this, again, sizing matters. Again, I'm not talking about the company here. I'm just saying when you make a $5 million, $3 million deal memo for a $105 million round, that is stupid. Okay. And so if you're the partnership that allows those kinds of things to leak through, you don't know what you're doing. So at some point, somebody should be held accountable for this. And I guess what's going to happen is the returns of CalPERS are going to cascade through everybody else thinking, well, at least I own some, H100s for a minute.
So let me stipulate. I think this could.
You want to take the other side, Brad, of that?
No, this is just an incredible team that's going to do. This may turn out to be a fantastic bet for, I don't know, Lightspeed or whoever led this round. Let me say something different.
So let me just pause this for just 1 second so you guys have a clear idea of what we're talking about. So the H1s that they're talking about are these processors NVIDIA puts out to do AI work. It's like buying a computer. Now, if you're a business and you go, hey, we got to start this business and we're going to go buy a bunch of computers, what's the value if you had to close your doors or you had to sell all your equipment? What's the value of that computer even a day after you bought it, right? We all know what happens to tech. The day you buy it versus the day after, there's this massive depreciation. And so these cards that are being used to process AI, this is what we're talking about, that these companies are raising hundreds of millions of dollars. And what they're saying they're going to use it for, some are saying we're going to use 30%, 50%, 80% of it to buy equipment to do the processing. Well, what's that process? What's that equipment going to be worth in a year, 2 years, 5 years? What's your computer worth that you bought 3 years ago compared to what you paid for it? That's what we're talking about, is people that are making these investments in AI, the investment's going into equipment. It's not going into actual intellectual property. And they're going to talk about and kind of clarify some of that. But I just want to get everyone caught up that these AI investments aren't actually in AI. They're in the equipment in a lot of cases. And they actually don't even have a product yet. They don't even have an idea. And there is just this over hot market of, well, I need to buy a logo. I need to buy into this thing. And Chamath coming up, I know he's a little vulgar, but coming up is going to explain the pattern that happened during the .com era, that happened during the social media era, that was exactly the same as what's going on now, and how many winners actually came out of this racket, and the timing. like that you don't actually need to be in right now. This FOMO that you need to be in AI and you need to be invested in AI right now is actually not a good idea. And that pattern actually played out during the .com and during social, meaning you could have gotten in 2 to 3 years later after the FOMO, bought into the good companies, a lot of the tide went out, and you would have gotten an insane return in like your Googles, your Facebooks, etc. Okay, so I just want to get clarity around that because there's a lot of nuances, obviously, in this world of AI. But before we went any further, I wanted to make sure you guys were clear on this. So let's finish this video up, and then we'll move to the next topic.
In 1997, 98, we had a similar phenomenon. Everybody thought internet search was going to be huge. There was massive FOMO and chasing, and everybody scrambled to get a search logo. Alta Vista, InfoSeek, Lycos, Go, Planet All, GeoCities. Just go through the list, that people were scrambling after. And the truth of the matter is almost all those companies went to zero, even though you got a couple bets right. You got the internet right, you got search right, but you didn't have to invest $1 in search until 2003, and you would have captured 98, 99%.
Do it again. Do it again now for social networking. Same thing. Do it again for social networking, Brad. Say all the names. Say all the names.
It's the same thing.
Same thing.
And so, when I look at it today, we have a huge anti-portfolio for AI. It's painful. We've said no to over 60 companies, right? But when we look around, I see a lot of our competitors doing a lot of these deals. Maybe they're teaser bets. I don't really know the size they're putting into those companies. But I suspect that if we believe this is as big as it's going to be and going to play out over decades, then putting a bunch of really small bets in order to buy a network or buy relationships or buy logos, et cetera, I don't think it's going to work any better this time than it worked then around social networking. But to be clear, there are going to be some people who lead these deals, who help these companies build incredible businesses. And those will, there are going to be some winners here. I think there's time to participate in the winners. Right now, a lot of this is unknown and unknowable. It will become more clear in the 1, 2, 3 years ahead.
The problem is for the LPs. Like if you are the LP, I am an LP in a bunch of venture funds. This stuff really turns my stomach because I'm like, wow, I am losing money every day. When I see these things, that's why I get so emotional about this. I think to myself, if the GPs that I've given money to are doing these kinds of deals, I'm screwed. At best, maybe I'll get back 50 or 60 cents on the dollar. And I immediately start thinking to myself, I really need to write this down. And I'm re-underwriting that person and that organization because I'm wondering, how can you let these things happen? Because if you just look back in history, you have to be really, really negligent to not learn that these things never work out the way that you think they are. And especially these kinds of rounds and this nominal ownership, the inability to defend ownership, it's just not a path to success.
I mean, also, if you think about this, Chamath, what company in recent history that got overfunded actually used that money logically? The magic of Silicon Valley is the milestone-based funding system. And whenever you short circuit that, this money becomes a huge distraction to founders. If they were to receive 10 million, 25 million, work for a year or two, then raise another 25 or 50 million, they don't need to raise all this money at once. This is like taking your ABC round, putting it all in
100%.
one. And all it does is distract founders. And then everybody coming for a salary says, well, you got 105 million in the bank. I want $3 million. I want $5 million.
What's the best example, guys, of a huge financial winner that raised these ginormous amounts of money? What's the best example?
Free launch of a product, Chamath. There's no product here.
What's the best example? Magic Leap? What is it?
Of disasters that actually...
No. What is the best example of a great company, I'm putting great in quotes, that raised these kinds of amounts so early in the cycle?
Quibi.
No, Brad, do you have an example? What's made money?
There are people who raised a lot of money over the life cycle, like an Uber.
No, I'm not talking about that.
They raised
3 rounds at once.
What was your first seed check into Uber? What was the total seed round? I can tell you what Facebook's was. It was $500,000.
It was 1.25, I think.
Okay, Facebook's was $500,000.
Yeah.
We needed a lot of money later. We needed a lot of money later, but no, it was 5 million. Sorry, 500,000 safe at 5 toes.
Here's
There was
another
a
thing.
$5 million valuation for Uber, 1.25, I think, when it. Yeah.
Here's another thing. Everybody walks in, they say, well, I have to raise this much money. And
Why?
it's good. This is a circular logic. I have to raise this money because I have to have all this compute. And I say, well, okay, you got to train it. We want to have a vertically integrated model. We want to train a model. I say, okay. So there's a huge upfront cost. And they're like, but I don't want to take a lot of dilution. So I have to raise it at a really high price. And so you say, okay, well, that's a challenge for you, not necessarily a good thing for us. And then they say, oh, and if you ask the question, is this an ongoing expense? They're like, oh yeah, we're going to have to retrain. Like, we're going to have to continue to spend this money. And I'm like, well, so if you're a software company, for example, and you say, well, what's my COGS? If all of a sudden you have an embedded COGS that's massive and recurring, right, for your compute costs that we haven't had in the past, then the revenue on the other side of that's got to be a multiple of what a traditional software company might have in order to get back to that set of economics. So I think there's a scramble, and understandably so. If you think the big win, AGI, or, this autonomous agent that's going to, be the top of the next funnel, that thing is going to be worth a lot. But to me, those are lottery tickets at this stage.
Can I tell you a little secret? Here's a little secret. When you put in $100 million into a startup to buy compute, you are not buying whiz-bang next generation IP. You are subsidizing CapEx. And that is a job that many, many other people will do at a very low hurdle rate. And so it is a law of capitalism that it could be the most incredibly innovative company in the world. But if you are offering money to them to fulfill a low yield thing, you are just not going to make a lot of money. When you put money into a startup that is there writing code to build groundbreaking IP, you own something that's really real. But that's because 80 cents on the dollar is going to core critical R&D in that point in time. And then they raise a lot of money at a lot less dilution when 80 cents on the dollar goes to sales and marketing. Then they raise even more money at an even smaller amount of dilution. You start to get to scale internationally. So you start to see, right, more dollars, less return, right? You're owning less of the critical differentiation. So if everybody is like, oh, it's so expensive for compute, I need to raise 100 million. Well, buddy, that's like a leasing function. You're like, all of a sudden, like, the best VCs in the world have become like Comerica Bank.
Yeah. I mean, they could have done it with the same structure, right? Comerica could have given them 50 million to buy these machines.
And maybe they should. And Comerica and JP Morgan and somebody else should basically say, hey, you know what? Here's a lease line for your H100s because I know they're worth so much, and I'll just write it at 10%. And my point is that the fact that people don't understand this is why the money will get torched. I would love a critique that says, actually, Chamath, you're an idiot. I'm right. I know that that's happening, but here's why I still see it happening. I don't hear any of it.
All right. So there's a little plug from the All On podcast. I think this is valuable, though, especially for those of you who are tuning in, looking for the next thing. The next moonshot, the next buzz that's going to make you a bunch of money. And AI, there's no question, AI right now is the hype. AI is where the money is going to. We're seeing the markets reacting to this hype, even though we're kind of in this inflationary recession or sideways market currently. But what's happening in the markets is a reaction to this. And I want to talk about this also because a lot of you guys might still be pretty bullish in the market. And I just want to give you some facts, some actual data that might have you screwing your head on a little better when it comes to your investments, or if you've got a retirement account, or if you're allocating funds or looking for something new to invest in, like, where should I be looking? Where should my red flags be? Obviously, AI, if you feel like you've missed the AI moment, you haven't. Chamath made a really great argument that we're not too late. We saw during the dot-com era, like the hunt for search, all these hundreds of companies that thought they had to have a search logo, and 99% of them died. We saw this during the social media craze, where we had hundreds of social media companies come up, and only a handful lasted, right? 99% of them also died. And you didn't have to be in those initial seed rounds to capture, like one of them said, 90% of the current gains. So you've got time to kind of let these things work themselves out. One of the main reasons that we're seeing this heated market in AI is there's so much cash that came from COVID. There's so much M2, so much money supply that happened because of low interest rates, a lot of stimulus money that got injected into the economy, more than we've ever seen. And a lot of that money is sitting with hedge funds. And I know you guys have heard this from me before, but what does a hedge fund have to do when you give it its money? Well, when you give someone your money to invest for you, specifically a hedge fund, you expect a return. And every time you see a monthly statement, or more often a quarterly, semi-annual, or annual statement, you expect to see a return, or in your mind, you're going to move your money. And frankly speaking, most people have no clue what these funds are investing in. They're not interested in doing that. They think they're the professionals. But here's one of the problems that Charlie Munger Buffett signaled around hedge funds. Mind you, they have their own funds as well. But the problem is when you put your money into a fund, there's this pressure to invest, where sometimes the best thing to do is nothing. Sometimes the best thing to do is get a small return compared to these massive returns that very clearly, and we've seen the pattern that happened in the dot-com and social media growth eras, that there's going to be a massive fallout that comes afterwards, kind of this tide swinging back. It cleans up all the bad actors, all the things that aren't going to survive. And frankly, you don't have to go through that and risk your capital in hopes to get a unicorn, in hopes to guess that you've got a large percentage in 1% of the 99% of companies out there alleging to do something about it. On this point, let's talk about the S&P 500. I think this is an important piece of data to show you guys. This is a chart that shows you the difference between the S&P 500 and the weighted S&P 500. This one specifically isn't a weighted versus total, although the charts look really similar. This is actually the top 7. So what we've done is we've taken the top 7 companies, 7 out of 500, and held them against all of the other 404 going on for business in the economy versus 7 companies that might be overstimulated right now due to what? Due to all this cash that got injected. So just look here really quick. So you got this blue line here, right? And this goes clear back into 2022, December 2022. You can see like we were at like almost a 0% return. Obviously, we saw some downturns into March of 2023, and then we saw this climb out. And if you're watching the S&P 500, that's exactly what it did, right? The price came up, dipped, and now we're kind of right back to that, not all-time high, but we're kind of back at that new high low, right, that we hit previous in January of this year. But if you were to take those 7 companies out, the top 7, look at this orange line. We would currently, in this month, be in the negative. We would have a negative return from the beginning of this year in the S&P 500 if those 7 companies were taken out. So why are people placing their bets in these 7 companies? And I would say it's the same hype, it's the same talk that's happening in this AI craze that's happening. These companies are allegedly leveraging AI, and a lot of them are, right? Google's definitely doing that. Meta's definitely doing that. They're either coming out with their, and Microsoft included, they're either coming up with their own language learning models, or they're saying they're going to build their own, or they're going to build the best. They're going to leverage this tech that in turn is going to maximize profits. And there's this big question mark called we'll see. Like, we really just don't know. We're in uncharted territory. The market is placing their bets that these companies will do it. And I actually have an explanation for this. Why is there so much growth in these stocks? And yes, there is a bunch in startups, but why aren't we seeing it in some of the smaller ones? And I'll tell you one of the problems we have in this country right now, and it's in the merge and acquisition world. And we're seeing it time and time again, these merges and acquisitions getting shut down by the feds, where the incentive to build a company, the incentive to build something new, and then, most companies don't go IPO. Most companies don't go public. They go through a process of getting acquired, or their technology gets purchased by a larger company. And a lot of these are getting shut down after they get started, right? Like Microsoft will want to buy a company, and the feds come in and say, no, you can't do that. This is a monopolistic approach. This would make you a monopoly. You're out. And so what are these top 7 companies incentivized to do? Well, they're incentivized to copy tech. They're incentivized to take a startup idea, to take a new technology, and rather than letting the world build these unique creatures and absorbing them and buying them, they're building them themselves. And there's frankly nothing illegal that the feds can do about that if it's happening internally. So if you were to weigh the options and go, we're going to go through all this work to do a merge on a product that one of these top 7 companies can do, versus build it ourselves and not have to worry about it getting shut down and spending millions of dollars trying to get through the acquisition phase, what are you going to do? And we're seeing this new trend of these mega tech companies internally copying software and looking at that as the option versus even a consideration of buying, unless it's just very clearly not going to have any issues getting through the purchase of being like a monopoly or getting shut down by the feds. So clear data, right, guys? I mean, this is staggering data, and I watch this constantly along with, let me bring this up, along with what's happening in the VIX. And I think it's important to follow. I follow the VIX almost every day. If you guys do not have a VIX chart or a way to pull up the VIX, I would highly recommend that this becomes a standard tool for you. But this Chamath's a self-made billionaire. This is not multi-generational money. And most of that money was made in trading. So yes, he got to start, made a bunch of money in some startups that he got involved in, then some VC stuff. But most of his gains recently has actually been in investing. And one of his strategies that he disclosed, I think it was sometime last year, was a VIX strategy on when to buy when the VIX is high, when to buy or sell when the VIX is high or low. And I just want to show you this because once you see the correlation between the S&P 500 and the VIX, you'll start to see when is a good time to buy based on the VIX being low, or when's a good time to sell, or excuse me, I have it flipped. When's a good time to sell when the VIX is low, and when's a good time to buy when the VIX is high? Now, the VIX is this kind of volatility indicator. It's a good indicator. And just so you guys know what we're looking at here, the black line on here is the S&P 500 price, and that price is listed on the right. And the VIX is the one in green. It's the value listed on the left. And when the VIX is low, that means the volatility is low. And typically when you start to see the VIX drop, you'll actually see the market climb. And so when volatility is low, market prices hold, people are hodling, they're holding the stock, they're holding whatever asset it is that they bought, and the price continues to rise because the more people that get into it, that's what causes the price of anything to go up, right? More volatility typically equals a drop in price. And so the higher the VIX goes, it's typically an opportunity to get in. It means that the price has dropped, has already come down, and this is a good entry price. So just look at this. If you go even from all the way to the right, you can see currently the VIX is spiking, right? And this is like very current. And you can see on the S&P 500, we're seeing a drop in the price. And this is this is just a, this is to give you an example. So this was back, I think I pulled this chart. This last one is September 2022, I believe. Yeah. So this is September 2022. I'm just giving you a correlation of like what was happening during that time, because the VIX currently is getting into this territory again. And I'll bring up a chart to kind of show you this. But when the VIX was rising last year, you can actually see that the S&P 500 was dropping to its all-time lows. When the VIX was at its all-time lows, the S&P 500 was at its highs. Again, I don't know if you guys can see my cursor here, but you can see when the VIX was at the all-time high, again, an all-time low. And so there's a simple correlation, right? It's like, oh, VIX, when it's down, probably want to be selling this thing, right? It means like you're probably at an all-time high in the price, but when the VIX starts going up, I probably want to start looking at buying. And a lot of people create strategies around the VIX just by itself in order to gauge when to buy into the S&P 500. Now, I'm going to combine two ideas, and this might be a little deep for some of you, but try to follow me on this. So I just showed you the S&P 500 and this weighted comparison where the top 7 stocks are basically carrying the S&P 500 in total. Now, if we start to see a large increase in volatility, and the only thing holding up the S&P 500 is 7 stocks, what do you think the price is going to do? Historically, there's this correlation, but if the amount of cash stored in these single assets, if the volatility goes up, like if you were to diversify over 500 companies, you would probably see a slower decline. But if you had it in all 7, my bets are on that you'll see a higher drop or a faster drop than you would if it were spread out over 20 companies or if it was spread out over 50 companies. And so I want to show you guys the VIX today, just so you guys are watching this. And the reason I bring this up is because a lot of you guys have, at a minimum, a lot of you have investments in probably a retirement account. You know, there's just so many out there, but some Vanguard fund or whatever, right? And you've given your money to your company, and they have the fiduciary right to make sure that like this money is being traded well. Well, they're just putting it into a fund. Most of those funds are in the S&P 500. We're starting to see allocation more in the bond market. We're going to talk about that here in just a second. But for the most part, your money's in the S&P 500 or some of those stocks. Now, having said that, some of you guys are actually trading this. Some of you guys are making your own investments in these stocks. And I think it's worth making a note where the VIX is today so that you can start maybe reevaluating where some of your funds are being placed. So year to date, VIX, you can just see this from the beginning of the year to current, the VIX has just dropped. And if you're looking at the S&P 500, what's happened to the S&P 500 since the beginning of the year, right? It's gone incredibly up. Well, we've seen this tick up over the last month in the VIX. And it's like this increase in volatility. In fact, if you even look at the last 5-day, we saw kind of the spike into early this week, and that we are seeing this starting to drop off a little bit because we're heading into the weekend. But overall, the VIX is slowly going into this climb. So I would be watching this really closely, because if you're in a bunch of stocks and you're happy with your returns, as this thing starts to tick up and show an incline up, it might be a good time to get out. And then wait for the VIX to go really high again, wait for the volatility to spike, and then that's when you buy back in. And at least that's the type of strategy that we're talking about. Having said that, where would you put your money? Like what? And again, not financial advice, do your own homework, but something I'm looking at is, where do I put my money then if I'm in a hold position? If I pulled it out, obviously the market's at an all-time high. A lot of you are wishing you had sold your cars last year. A lot of you are wishing you had sold your homes last year. And that's what I'm talking about. Now, the markets, the S&P 500 may be at that high right now, and there may be some pullback. There may be some retracement that happens really soon. And I'm trying to give you guys some tips, like I did with the housing market, like I did with the car market a year ago, that if you've got a bunch of cars, you may not want to be holding them all right now. Obviously now it's a little too late. The car market's starting to stock up. There's tons of supply. If you go to a new car lot right now, they're already saying like there's a surplus of cars, and they're going to be making tons of deals this year. So if you're in the market to buy a car this year, minus the rates, it's going to be a great year. There'll be tons of incentives to buy cars this year. But where would you put your cash? Where's a safe place that you could put your cash and it would have a potential return, and we would see the opposite of this, right? Something that maybe is not in such high demand. And this is where I'm going to transition into the bond market. So before we do that, let me bring this up. I want to show you guys. Oof, I'm running out of time. I want to show you guys the bond market. And just really quick, I'm just showing you guys this because I want you to see the 1 year return, 1 year rate. This was the first month that we've had over the last 12 months, even I think longer than that, where we have not increased interest rates. And so we did a pause, or there's like 5 different terms floating out there, but we basically paused interest rates. The Feds are committed and have told us multiple times, they're not liars. They've told us multiple times they're going to increase rates 2 more times. Do I think that's going to happen? Yes. Is it going to happen this year? Yes. And then how long will rates stay high? And that's the big question. That's the big bet. My guess is 3 to 5 years. My guess is to get into where it needs to be, to keep interest rates low, or to potentially bring them back down, and to keep inflation at that 2% level that like we have to be at. Rates are going to stay high, and they're probably going to stay high for like 3 to 5 years would be my guess. But people are trying to time this market. They're trying to time when rates are going to either go flat or start to drop. And there's a reason. There's an opportunity here. And bonds are a safe bet. And let me tell you why. I'm going to actually play a video on this. But bonds are actually a safe bet because, one, you'll at least at a minimum get the maturity date return, right? If you buy a bond from the US government, you're going to get whatever that return is at the expiration of that bond, period, right? There's no loss risk other than inflation. But you could actually sell that bond for more if rates go down. And there's a correlation there that I'm going to talk to you guys about here. No one really else is talking about this because it's boring. It's not growth stocks. It's not simple where you just buy and hold something and hope that it goes through the moon, right? Like we've already seen. Well, those markets might already be cooked. And so if you've got money that you're trying to keep safe and hold for the next time the market comes down and you buy in to climb it back up, bonds might be your answer. So I'm going to spend a significant amount of time on this podcast today going over this because it's my goal to help protect your wealth. It's my goal to help you grow your wealth. And you're just not going to do that risking your money in, like we saw, AI stocks where 80% of your money is going into GPUs that frankly aren't going to be worth much. Going to kind of set the, here we go. This will kind of set the tone real quick. And this is just a really quick 3-minute video where one of the guys that I like to follow on Yahoo Finance does some price correlations to the interest rates and bond market. And he's seeing a bunch of gaps. And he's right. I went through the charts and there are some massive divergence in certain assets compared to bonds. And I thought this would be really valuable for you guys to see some of the correlations. So let's watch this.
Stocks slipping today as traders eyeing headwinds for the global economy and also digesting the Fed minutes from the last policy meeting. Yahoo Finance's Jared Blickery here. The closer look at some of the losses that we're seeing, but also the movement in the 10-year today.
Yes, I think the 10-year is very telling about what the direction is perceived with respect to the Fed, and that is higher for longer. So let's see, 10-year is up 9 basis points today to 3.95%. On a 3-month basis, you can see easily the highest level we've seen in many months. Here's the year to date, and I'll put a line chart so it's a little bit easier to see. Actually, let me put a 1-year chart, and I can draw a trend line down. This matches rather precisely on the candlestick chart, so a definite break to the upside here. Now, the interesting thing is tech stocks typically do not like higher rates, and especially on the 10-year, the longer rates. Nevertheless, over a longer period,
say, by the way, this came out yesterday. We just talked about tech stocks, right? We just talked about the S&P 500, how they're being propped up by the top 7 stocks. I think there's some strong correlation here and arguments here that he's not making around why, even though the 10-year note yield went up this week significantly, tech stocks did not rally. We know why. And we just talked about some of the holes. I just punched a bunch of holes and why that's not going to work long term. That is not going to work. Are 10-year yields going to drop? Probably not. And if they do, it's not going to be on the premise of like these 7 stock. Like, we're going to have to see some real GDP. We're going to have to see some real value here really soon in order for that to drop. So there's a really strong argument that the value of the 10-year note's going to go up. Yesterday, people are waking up. And so this is a sign that people are waking up to what's going on. I'm hoping to wake our group up a little bit around this. But here's some of the correlations also that he makes with the divergence in other commodities and assets.
I've been noticing here. First, we have the New York FANG index, and we can guess what that is. It has a lot of heavy weighting towards some of those heavier growthy names versus bonds. And for bonds, I use TLT, and that's inverse to yields. So when I said tech stocks don't like high yields, well, guess what? We are seeing higher yields now because we see a lower TLT, but what has happened in New York FANG and those growthy stocks have exploded to the upside here. Now, let's check out another correlation. This is stocks versus copper. So I have the S&P 500 ETF versus copper, and Dr. Copper is kind of a referendum of where the economy is. What I want to point out is that copper, this blue line right here, cyan, has been trending down while stocks have been going up. This too is a divergence. Usually,
again, copper is an indicator of the economy, typically, historically, but we're still seeing this like rise in tech stocks, rise in growth stocks. Growth stocks are these projections into stocks that have not yet given value, have not yet given a return.
there's a resulting convergence. And so somebody's going to have to either catch down or catch up here. Finally, want to show you another correlation, tech versus home builders. No decoupling here. Just an interesting thing I happened to notice when I was going through a bunch of these. This is a very closely correlated pairs trade, except there's no, in a pairs trade, you usually have one long and one short. Here, you just have 2 longs. So let me get back to the main market and we can plot some heat maps and show you what's going on. One of my central theses coming out of the first half of the year is that strength, like we saw in the first half, usually begets more strength in the second half. That does not preclude some painful rotations. You might not even see it in the passive indexes like the S&P 500, but under the hood, we've seen a lot of painful rotations over the last few years, not precluding that. Here's the sector action for today, utilities. That is an interest rate play. Interesting to see that. That's up 1.5, followed by real estate, also interest rate play, communication services and consumer discretionary and healthcare, all in the green there. So going to be an interesting second half to the year. I promise you that. That's all I can promise.
It certainly will be. We'll see who's leading the way in the second half, right, Jared? Thanks.
All right, simple enough. So there's no question that the reason the volatility index, the VIX, is coming up is because there are a lot of problems in the market right now. There's a lot of convergence in markets that typically don't converge. There's divergence that isn't happening. And so the markets will correct. And I can tell you where I'm placing my bets. I can tell you based on the data that I've shared with you guys, kind of where I'm placing my bets. I've gotten a lot of feedback on like this whole bond thing. And I get that it's new. I get we haven't talked about bonds for over 2 decades. It has not been a hot topic. It has not been a thing that people have been interested in buying or getting growth out of, but we're there. Like we're in a new world where bonds are and will be the topic probably for the next 3 years. I would say we're probably on the front of that, leading that discussion with our traders and the people following us. For that reason, I want to share a video that I just think it's boring. I get it. but you've got to understand this. You've got to understand the correlation between bonds and interest rates, and more importantly, like how to buy them, what correlations exist when you buy them, what coupon rates mean, what the price means over time if rates go up or if rates go down. So that way you understand the correlation, and then you can go, oh my gosh, that's happening right now. So therefore, bonds should fill in the blank. And so we're going to watch that really quick. I've sped it up so it's only 10 minutes long. This will take the majority of the rest of our podcast. And then ending, I'm going to talk about some of the AI scams that are happening in the world right now. Do a really quick recap on what's happened with crypto, and then give you a sneak peek into next Friday's podcast, where I'm bringing one of my business partners, Keaton Schultz, who's a real estate expert on the East Coast, who's going to be joining us next week when we do our real estate recap, as we look at the data first and give you the data before everyone else, before the news actually gets out for this month. So let's start with this video and we'll go from there. It's back.
What I want to do in this video is to give a not too mathy explanation of why bond prices,
I'm going to turn this up
why
for you
bond
guys.
prices move in the opposite direction as interest rates. So bond prices.
And I sped
versus
this up
interest rates.
also for you guys.
So to start off, I'll just start with a fairly simple bond, one that does pay a coupon. And we'll just talk a little bit about what you'd be willing to pay for that bond if interest rates moved up or down. So let's start with a bond from some company. So let me just write this down. This could be company A. It doesn't just have to be from a company. It could be from a municipality, or it could be from the US government. And let's say it's a bond for $1,000. Let's say it has a 2-year maturity. 2-year maturity. And let's say that it has a 10% coupon. 10% coupon paid semi-annually. This is semi-annual payments. So if we just draw the diagram for this, obviously I ran out of space on the actual bond certificate, but let's draw a diagram of the payments for this bond. So this is today, do it in a different color. That's today. Let me draw a little timeline right here. This is 2 years in the future when the bond matures. That is 24 months in the future. Halfway is 12 months. Then this is 18 months. And this right here is 6 months. And we went over a little bit of this in the introduction to the bond video, but it's a 10% coupon paid semi-annually. So it'll pay us 10% of the par value per year, but it's going to break it up into 2 6-month payments. So 10% of 1,000 is $100. So they're going to give us $50 every 6 months. They're going to give us half of our 10% coupon every 6 months. So we're going to get $50 here, $50 here. These are going to be our coupon payments, $50 there. And then finally, at 2 years, we'll get $50, and we'll also get the par value of our bond. We'll also get $1,000. So we'll get 1,000 plus $50, 24 months from today. Now, the day that let's say this is today that we're talking about, the bond is issued, and you look at that, you say, you know what, for a company like Company A, for this risk profile, given where interest rates are right now, I think a 10% coupon is just about perfect. So 10% coupon is just about perfect. So you say, you know what, I think I will pay $1,000 for it. So the price of the bond, the price of that bond, right when it gets issued, or on day 0, if you will, you'd be willing to pay $1,000 for it. Because you say, look, you know, I'm getting roughly 10% a year, and then I get my money back. 10% is a good interest rate for that level of risk. Now, let's say that the moment after you buy that bond, just to make things a little bit, obviously interest rates don't move this quickly, but let's say the moment after you buy that bond, or maybe to be a little bit more realistic, let's say the very next day, interest rates go up. If interest rates go up, let me do this in a new color. So let's say that interest rates go up. And let's say they go up in such a way that now that they've moved up for this type of a company, for this type of risk, you could go out in the market and get 15% the coupon. So let's say for this type of risk, you would now expect a 15% interest rate. Obviously, for something less risky, you would expect less interest in that. But for a company just like Company A, you would now expect a 15% interest rate. So interest rates have gone up. Now, let's say you need cash and you come to me and you say, hey, Sal, are you willing to buy this certificate off of me? I need some cash. I need some liquidity. I can't wait for the 2 years for me to get my money back. How much are you willing to pay for this bond? Well, I'll say, you know what? I'm going to pay you less than $1,000 because this bond is only giving me 10%. I'm expecting 15%. So I want to pay something less than $1,000 that after I do all of the fancy math in my spreadsheet, it'll come out to be 15%. So I'm going to pay, so the price, so in this situation, the price will go down. And I'll actually do the math with a simpler bond than one that pays coupons right after this. But I just want to give you the intuitive sense. If interest rates go up, someone willing to buy that bond, they'll say, gee, this only gives a 10% coupon. That's not the 15% coupon I can get on the open market. I'm going to pay less than $1,000 for this bond. So the price will go down. Or you could essentially say that the bond would be trading at a discount to par. Bond would trade at a discount to par. Now,
the reason, guys, that this happens, the reason that it trades at a discount is because interest rates kept going up. So we're at a pinnacle. The feds are pointing to 2 more rate hikes, and then that's it. Like the opportune moment that rate hikes won't be going up anymore, and the potentiality over the next 3 to 5 years that they will drop. And so if this happens when rates go up, what do you think happens when rates go down and you own a bond? Well, now you have something that has a higher interest rate than what the actual rate is, and people are willing to pay a premium for that. And he's going to talk about that in just a sec.
The opposite happens. Let's say that interest rates go down. Let's say that we're in a situation where interest rates go down. So now for this type of risk, like company A, people expect 5%. People expect.
And by the way, he's talking about municipal bonds. He's talking about corporate bonds. I'm saying government bonds, like government issue, probably the safest bond that you could ever get into. Like our country would have to fail. And if our country failed like stocks wouldn't matter at that point, right? Like none of that stuff would have any value. So it's like the last domino to fall. And so really, from a risk standpoint, minimum, you're going to get the rate of return at the option of maturity, period, right? But if you need to sell it early and you bought when rates were at the all-time high, you are positioned to sell a piece of real estate, so to speak, a bond that's actually worth more because people are going to pay for that premium. People, if rates are at 4%, but you have a 5% bond, people are going to want that 5% bond. They'll pay an increase, right? They'll pay more than what you paid for it to get you out of it so that they can hold it longer into maturity. And a lot of the companies, like they're not people like you and I trading. The people wanting those bonds are people like insurance companies, companies that are running funds, and a certain percentage of their funds are in the bond market, and they're looking for something they can hold at a higher rate for a longer term.
5% rate. So how much could you sell this bond for? Well, if you weren't there, and if I had to just go to companies issuing their bonds, I would have to pay $1,000 or roughly $1,000 for a bond that only gives me a 5% coupon, roughly, give or take. I'm not being precise with the math. I really just want to give you the gist of it. So I would pay $1,000 for something giving a 5% coupon now. This thing is giving me a 10% coupon. So it's clearly better. So now the price would go up. So now I would pay more than par. Or you would say that this bond is trading at a premium to par.
So what's happening as he describes this?
So at least in the gut sense,
people are
interest rates
scaling
went
in.
up. People expect more from.
People are, as we speak, smart investors. In fact, Chamath, one of the guys we listened to, has hinted over the last 6 months his bond strategy. Like he is buying in or scaling into bonds right now, and is one of the richest people that I follow. Like one of the richest people that I am constantly watching to see what he does next. Why? Because he's been one of the smartest investors over the last decade, where he's outperformed guys like Warren Buffett. He's outperformed guys like Charlie Munger.
This bond isn't giving more, so the price will go down. Likewise, if interest rates go down, this bond is giving more than what people's expectations are, so people are willing to pay more for that bond. Now let's actually do it with let's actually do the math to figure out the actual price that a rational person would be willing to pay for a bond, given what happens to interest rates. And to do this, I'm going to do what's called a zero coupon bond. I'm going to show you a zero coupon bond. And actually the math is much simpler on this because you don't have to do it for all of the different coupons. You just have to look at the final payment. So a zero coupon bond is literally a bond that just agrees to pay the holder of the bond the face value. So let's say the face value.
All right, guys, we we're clearly running out of time here. I'm not going to have time to show you this whole thing, but if you want to get caught up and you want to see the rest of this video, khanacademy.org has this full video. He has a full course actually on bonds that's completely free that you can get up to speed and educated. That's another plug. I don't get paid by these guys. They don't even know I'm doing this for them, but there's a plug for these guys on this because I think it's really valuable to understand how bonds work. Because in the next, you're going to remember me when you hear this and you start hearing echoes of it. In the next 2 to 3 years, bonds will be all we're talking about. It will be the thing that most investors are talking about. You're going to constantly be hearing a lot about bonds, and that's because there's a shift happening in the marketplace. And it's not the end of the world. This has happened multiple times, even in the last 100 years, where the shift in where we invest and where the money goes has been the bond market. And we're just going through another phase of that right now. So I want to give you some of my last nuggets before we get off, because there was just so much that happened this week. I'm going to talk really lightly without going through some of the details about this AI scam that's going on right now. I will bring up a quick page that I found that briefly talks about this. Let's see if I can get this up. No, can't. Okay, so that's no problem. But I want to talk to you about AI scams. With anything that's hot, with anything that is new and innovative, obviously you're going to get these guys in dark cloaks that come in and pretend to be using something special and cutting edge. And somehow the big players like Google and Microsoft don't have this, but yet you'll have access and you'll be able to make, some ridiculous return. Well, first and foremost, if it sounds too good to be true, you guys know it usually is. And if it's using AI as like the hot button, the logo, then I would add additional red flags. If it's using AI and crypto, I would add like 10 red flags. I would say most things that I've looked at that are AI crypto driven, and they're promising they have this robot or this thing that's generating 1% to 2% a day. One, it's very likely it's not AI. It's very likely. Two, it's probably one of those robotic scams that were being talked about. I mean, I've been in the trading world for years. It's one of those AI robotic scams that has been around, and they just rebranded and put an AI logo on their stuff. And frankly, they're not doing anything in AI. Yeah, they're using ChatGPT's poem writer to maybe help write some algorithms or something. And at best, scammers are scammers. They don't even care if what they're doing is partially true, right? So you got to be really careful with these. I would not put my money into any type of robot that is making any type of return guarantee or any type of social media push. If there's something you're seeing on social media and it's saying, hey, there's this robot and all you have to do is put in your money and you'll get a return, it's using AI, I would avoid it like the plague. I would stay away from it. It would be something that has been scaled up on a much more massive level if it was legit and real, and it's very likely a Ponzi. The US, there's multiple states that have been reporting some of these AI-crypto scams that have been going on and verifiably have called them Ponzi's, meaning that they're not even trading money, taking other people's money to give you their return, and there's not even an actual thing going on. So just be really careful with anything that says AI on it and you're feeling enticed that it's going to give you a return. It's very likely a scam. If there's not a way to test it, there's not a way for you to see what's going on behind the curtain, I would avoid it. And just frankly, it's your money, keep it safe. The other thing I want to talk about really quick before we get off is, and I talked about this in a couple of my shorts and videos I'll be talking about next week, is the death of crypto. Now, I'm not saying crypto as a whole, blockchain as a whole, I think will hold. There will be some stable coins that will hold. There will be some major coins like Bitcoin, Ethereum that are going to hold. But the industry as a whole is going to go through a massive winter. And I would say 99% of all crypto affiliated companies, startups, etc., will die. Specifically in the token market. And I hate saying this because I know so many people in this industry. I know so many people that have built strong businesses with great ideas, and they're using tokens as like a way of funding or a way of entry. But the reality is the SEC is coming after tokens. They have clearly put a flag and said anything that is a token anything that like even Binance coin is being currently accused by the SEC as a security. Anything like this, the SEC is basically saying it's a security registered, and they are going to come after this so hard that it is going to squeeze 99% of all tokens, all the value, just like squeezed out. And then you look at the industry as a whole, and what has crypto actually done? What has it given us in terms of like tangible, actual product, like actual software or things that are going to help the community or make a difference? We've got NFTs, right? We've got this art and this way to like put digital art on the chain. And then we have the idea of a currency. Outside of that, there's not much that's been built. You know, there's been talk and a lot of work done in like the sovereign identity space, but for the most part, that's it. And so you're going to see, just like we saw in the .com, you're going to see just like in the social media booms, you're going to see 99% of the people that were branding, like, hey, we're the NFT, we're the NFT marketplace, we're the brokerage. You're going to see 99% of those go away. And I've lived through this, and in the trading market, when we first got into currency trading, the same exact thing happened. There were thousands, guys, of brokers, thousands of currency brokers in the US. It was going through the same patterns that we're seeing in the crypto market. We're literally and I would say 99% of those are going to go away. The US has a tendency to overregulate, and it makes the big players bigger and the small players completely go away. There were probably 10 brokerages just in the state of Utah. None of those exist anymore. They either got bought out, squeezed, or they had to close their doors due to fines and fees imposed on them. And that's what's going to happen again. The fact that the SEC is going after some of the big companies like Binance and Coinbase currently, and is saying, hey, you screwed up. You sold unregistered securities, which is all these tokens, and they're actually reacting to it now. You're seeing right now Binance and Coinbase redacting. They're like pulling back on some of these tokens. They're actually not allowing some of these transactions to happen on tokens right now after this SEC scrutiny. It's just going to go through a squeeze, guys. We're going through a winter. So what to look for there? Opportunity, right? Anytime you go through a winter, anytime you go through a tide coming out and then a pullback, that's when you want to start looking to scale in. So now is the time to start actually looking for good buys. It's now to start looking for like, are we at the bottom? Is now a good time to position back into the crypto market? Will it have a place in the future? I believe so. Was it overcooked? Absolutely. Where have the funds gone? I would say a lot of the funds that were in crypto have just shifted to AI. And that's where we're kind of going to see the same cycle happen again. In closing, next week is our real estate market. We call it the Friday forecast, and we do it every second Friday, where I actually get the data for the national real estate, not commercial, but residential. And we go through all of the charts, and you'll hear it here first before you'll hear it in the news, before you hear it in the market. So if you are in real estate, you're a real estate agent, you know people who are agents, this is a great place to tune in for that data, because frankly, most agents don't know. Frankly, most people, brokers, people who are loan officers who are in the market, and this actually affects their business, I would say they're 3 to 6 months behind the data. A lot of people don't know that we have already gone through a pullback in real estate in the country. It's already happened. We are not back to all-time high prices. In some states, we are seeing record lows. Some of the things we're going to talk about next week are how foreclosures are up. And by the way, I am getting just slammed. I have trolls, clearly people that this is going to impact, and they somehow think my voice is going to drive the market down. But I'm just getting trolled on talking about the truth. Foreclosures are going up, guys. It's the data. Airbnb revenues have dropped up to 50% in some states, in some areas. In fact, we're going to see a massive fallout in the short-term rental market. Malls are shutting down. Commercial real estate is not done. It may be priced in with banks, but it is not over. We're going to see continual drops, I think, in the CREs in the commercial space. And I've got one of my real estate expert friends who I do some real estate with back east, Keaton Schultz, who will be on with us next week. So stay tuned. Be with us here, same time, same place. This is the Market Pulse podcast. I'm Matthew Pohl, your host. And we'll see you same time, same place, guys. Thanks for joining me. Give me any comments or feedback, and we'll see you here next week. Thank you.